Thank you for joining us on Business Incorporated. I'm Chimeze Obi Iwagu. On the program today, Egypt extends rate pause with eye on global economic risks. Foreign direct investment into South Africa falls by almost half amid global downturn. And Kenya's private sector activity rises to 53.2 in January. We get the show started now with the market numbers. And here on the African continent, the Nigerian market and the South African market went sideways at intraday, while the NSE sustained its negative trend and was down 0.36% as at midday. The JSE index in South Africa advanced 0.93%. In the meantime, the market in Egypt closed for the week negative on Thursday by 0.17%. Kenya ended Thursday's session positive. And markets in the Middle East also closed for the week negative on Thursday. In the UAE, Dubai's index lost the most by 1.54%, while the Abu Dhabi index was lower by 0.19%. Elsewhere in the region, Saudi Arabia's index declined 0.88%, while the Qatari index shed 0.39%. Let's cross over now to Europe, where stocks were mostly higher on Friday morning as investors look to vaccine rollouts for hopes of normalization, while global markets flirt with record highs. Conrad will give us all the details. Hello, Conrad. Good afternoon.
Good afternoon, Jimmy, and let's say it loudly. Thank God it's Friday.
Thank God it's Friday. Before we say that thank God it's Friday, let's look at some of the issues there in the European space. The S&P 500 in the US and the Nasdaq index both have reached new record highs. What's the situation like in Frankfurt, where an update on German factory orders was due today?
Well, Jimmy, the stock market here is also in record high direction. Here you can see the German share index DAX is trading only a few points below its latest record high. The MDAX, which is the German mid-cap index, it has reached another record high already today. And this despite the fact that those factory orders numbers for December indicated a decline compared to November, and this after 8 consecutive months of rising factory orders. But if we compare December with the December the year before, I can say that the order situation is still pretty solid. And of course, we know that this decline in factory orders has to do with the newly imposed lockdowns in Germany and also in many other countries. So the hope among investors that eventually the economy will recover after we have seen the vaccination programs kick in and that really the pandemic will come to an end, that the economy can restart there. This scenario remains intact. How much the hopes are on this vaccination can be shown in the 30% increase of the shares of CureVac this week. CureVac is a small German biotech company that also has developed a vaccine. It's now announced that it's partnering with Bayer, the large pharmaceutical company, and of course this partnership increases quite significantly the profit outlooks for this vaccine.
With the currency market there, the euro has been strong for the months of December and January. Now, the exchange rate has dropped below $1.20 again. Which one of the currencies are risk on and risk off right now?
It's a very good question, Jimmy. It seems that in the weeks after the US election, December and January, investors were, more nervous about the United States and the outlook of the economy there. Of course, with Donald Trump constantly denying his election defeat, nobody could know what kind of development that would take and what kind of impact this would have on the economy in the US. So during these weeks, really, when investors felt that it was a good idea to become a bit more risky, they thought about Europe and they invested in Europe and in the euro currency. This is now changing again. We have news like today's factory orders from Germany, slightly weaker. We have Italy, the concerns about the government there. And at the same time, America is stabilizing with the Biden administration, with the huge stimulus perspective by this administration. Hopes are higher for the US economy. Again, things are getting a bit back to normal, you know, with the American economy being a little bit stronger than the European economy. And that is, of course, something favoring the US dollar.
And in the auto industry, the worldwide scarcity of computer chips continues to bother the car industry. Today, Ford and Subaru reported that they don't have enough semiconductors to keep their production up. What about the German car makers, Mercedes, BMW, Volkswagen? How bad is the situation for them?
They also have problems. They have a tendency not to want to talk too much about how bad it is. Mercedes and Porsche have announced that they're preparing stockpiling of computer chip capacities, which is, of course, a shift away from this just-in-time production management that they have gotten so used to. Other companies like the large auto industry supplier here in Germany, ZF Friedrichshafen, its CEO says, we should think about having more production of computer chips locally again, you know, like in the country. And that, of course, indicates that this CEO at least thinks that globalization somewhat has gotten a bit more of a hit and that one should think local again. Of course, the pandemic is playing an important role here as well. It has also pushed demand in many industries for computer chips. So there's a competition for the supply of computer chips, and the computer chip makers, they serve first who pays most.
Well, Conrad, I guess it's now time to say thank God it's Friday. So while you enjoy your weekend, please remember to keep safe and be well.
Thank you. Have a great weekend.
You too. Okay, Britain's energy regulator has lifted the cap on energy prices for millions of households for the first time in 2 years after a big rise in wholesale energy costs. This and more are what we will be chewing with Juliana. Hello, Juliana. Good afternoon. Well, Ofgem announced that from April, the energy price cap will return to pre-pandemic levels as demand for energy has recovered, which has pushed wholesale prices back to more normal levels. Does that mean that you'll be paying less for energy you consume?
Not less, as you said, Chimazé, but much more. And this is going to affect about 15 million families across Britain, unless you are on a fixed rate. There are millions of people that do have fixed rate energy bills. As you said, Ofgem, the regulator, they typically look at whether or not they will be changing or reviewing the base rate every 6 months. It has stayed low for about 2 years. So this is the first time we are seeing an increase. They have cited the fact that demand for gas is on the rise since it plummeted during COVID-19. And so it will increase by £96 per year. It isn't just COVID. They've also added £23 a year, and that's because they want to help some of the gas suppliers pull back some of their lost earnings. You know, Chancellor Rishi Sunak did advise not just banks and mortgage companies and car dealers, but also gas companies to try and provide some sort of holidays for people that were struggling to pay the bills. So this is when it's going to be clawed back. They said they have no option but to do this. This will begin in April. Pretty much a big story here in the UK. We actually have a statement from the chief exec of Fuel Poverty Charity. He said people on the lowest incomes and in the worst housing are always the hardest hit. We do have a lot of problems with some poor, debilitated housing here in the UK. Lots of very, very old Victorian homes. He says heating a poorly insulated home costs around £50 a month, more than a decent home. If bills rise by about £100, millions of households have two stark choices: stay cold or fall further into debt. So that's not been taken or received nicely here in the UK.
And markets are also watching the US job data. How is that filtering into the intraday trading?
Yeah, I wanted to sneak my phone onto set, actually, to have a look, because the US jobs data is due in right about now. This is seen as kind of the first big test for President Joe Biden. I don't have that data, I'm afraid, although I'm sure it's probably could be flashed on the screen a little bit later. But a lot of economists and analysts are expecting to show a drop in employment in the US because, of course, lots of people hire for Christmas and then you let a lot of employees go in January. So that's what we're expecting. The FTSE actually opened higher. It's still high at intraday, and this is despite some negative data that we've had from Halifax. They've been looking at house prices in December, and it does show that house prices have fallen by 0.3%. This is the first time we're seeing a fall in a drop in house prices in the UK since April. We know it was one of the first sectors to be given the green light by Prime Minister Boris Johnson after the first lockdown. We have seen a big boom. This is helped by the cancellation of stamp duty, but economists did predict that it was completely unsustainable, and we're starting to see the signs of that. And even yesterday, the Bank of England Governor Andrew Bailey, when he was giving his minutes after the MPC meeting, did say that he does expect a lot of house owners to start defaulting on their mortgage payments, and there to be a little bit of less demand in the housing market because people are still very unsure about the economic outlook. So I'll quickly go through the numbers. The all-share is up 0.19%. The FTSE 100 is up by 0.09%, and the FTSE 250 also up by 0.55%. We're still seeing the rally on the pound. It's up against the US dollar by 0.15%, up on the euro by 0.03%, and up on the Japanese yen by 0.18% at intraday, Chimney.
Okay, as the week wraps up, what's the outlook for next week?
Well, more COVID, I'm afraid. That's what we're expecting. But I think for next week, there's only one piece of data that everybody is going to be focused on here in the UK, probably going to keep Chancellor Rishi Sunak up at night, and that's the all-important GDP, year-on-year GDP figures we're expecting, and final Q4 GDP figures. We obviously contracted by 18.9% in Q2. That was followed by a kind of record-breaking increase and expansion of 16.3% in Q3. We're expecting a fall of about 2%. Andrew Bailey expects it to be about 1%. In November, after 6 consecutive months of growth, we also saw a contraction because we went into this second lockdown. Everybody is predicting that Britain is going to be heading into this double dip recession, and we're still not sure when we're going to be getting ourselves out of lockdown. Boris Johnson now under increasing pressure, not only from his Chancellor, but from the British public. You know, people are sick to death of being at home. We've seen protests across Europe. The data does show that, you know, the numbers of COVID are falling down. So if these GDP figures are as bad as people feared, there are going to be questions as to when we can finally get the British economy ticking again.
All right. Thank you, Juliana. Well, I guess we can as well say thank God it's Friday. So go get some rest and have a great weekend. Well, it's been a packed week in Ghana, starting with the new restrictions imposed by the government as coronavirus cases continue to rise in the country. Then came the debt stock report showing the government's debt had jumped and is currently at 74.4% of economic output, and then the first monetary policy decision for the year. Okay, let's talk to Alabi John Kennedy, the managing partner at Bespoke Business Consulting, to make sense of all of these. Good afternoon, Mr. Alabi. Thank you very much for joining us. It's always a pleasure to have you on the show.
Hello, thank you for having me.
So Ghana's debt stock is currently at about 74.4% of total economic output measured by GDP. Has the government outlined any plans to reduce this? What sort of solutions are economies like you preferring?
Basically, even before now, the IMF had forecast that the debt stock to GDP would be around 76.7%, but later revised to 74.7%. And after basic analysis of the economy, the government of Ghana were able to find out that is within the reach of IMF as per their forecast, between 74.4%. Now, this has been going up since 2016 from 58.3% up to now. and it's a bit worrying. Now, as it is now, the Ghana debt stock is a bit worrying because it's going to make Ghana a highly risky country to invest. Now, this is not peculiar to Ghana alone. It's also peculiar to about 11 countries in the sub-Saharan Africa. And now what the government is trying to do is to make sure that they are able to have discussions with their creditors to extend payment tenors and to see if they can renegotiate the interest rates. And you would note that most of these loans are external loans and they are loans contracted in USD. Now, if the internal currency is not performing well, this will actually affect the currency in Ghana. However, it also helps to make sure that we get more revenue if that is contracted in USD. But basically, it is very worrying, and we hope that when they increase the tax revenue internally, it helps to get more revenue to pay for the debts. That's one. Secondly, the negotiations will also help to put the mind of creditors at rest. And thirdly, the performance of the cedi in the country can also help to make sure that we are able to amass more revenue to pay out our debts.
Yeah, so a day after the debt stock report was released, the MPC met and retained rates at 14.5% for the 5th time. What do you make of this decision?
Yes, what it means is that they are trying to make sure that interest rates doesn't go up. It's not surprising to us because normally if the MPC rate is a business for which interest rates are generated within the financial sectors and all of that things are determined. So they are trying as much as possible to make sure that the interest rate is within the reach of every Ghanaian to be able to contract funding as it is now, where we have a surge in the coronavirus within the economy.
And earlier in the week, President Akufo-Addo announced the reimposition of a raft of restrictions to help curb the rising COVID-19 infections in the country. How stringent are these restrictions, and can the economy handle that right now?
Well, I think as per the government of Ghana, they normally take medical advices, health advices from health technocrats, which is the Ministry of Health, and they've advised that because of the surge in the level of the coronavirus, they are supposed to take some stringent restrictions, and that's what the president did last week. Now it's a bit hard, but I think they are trying to take hard decisions to make sure that they are able to cope this coronavirus. Yes, it will affect the economy, but you have to make sure you balance both the health of the citizen and the health of the economy. If you intend to make sure that the economy is healthy, then the health of the citizen should be top A. So basically, I think it's the right decision, and I'm sure the economy adjusts to it, even though it's a bit difficult, but we are pulling through gradually.
Right. All right. Thank you very much for sharing your thoughts there with us. And the Monetary Policy Committee of the Central Bank of Egypt has held interest rates, putting monetary easing on pause for another month as the coronavirus keeps global markets on edge. The deposit rate will remain at 8.25% and lending rate at 9.25%. After cutting a combined 850 basis points in 2019 and 2020, authorities are treading a cautious path amid mixed signs of when the pandemic will ease. Adjusted for prices, Egypt's policy rate is the highest after Vietnam and Malaysia, among more than 50 major economies tracked by Bloomberg, an important factor in attracting foreign investment in the country's debt. And foreign direct investments into South Africa, a key component of President Cyril Ramaphosa's push to kickstart the country's struggling economy, fell by almost half in 2020. South Africa attracted $2.5 billion in new foreign investments in 2020, which is a 45% drop from the $4.6 billion recorded in 2019. Although the South Africa's FDI fell, the country secured 2 large investments last year, an undersea fiber optics cable by Google and the announcement that PepsiCo was acquiring Pioneer Foods. And Kenya's private sector activity jumped in January, with output increasing after the reopening of schools and more businesses that had been closed to curb the COVID-19 pandemic. The market Stanbic Bank Kenya Purchasing Managers Index jumped to 53.2 in January from 51.4 a month earlier. According to the report, firms highlighted that the reopening of businesses and improved cash flow in the economy helped to generate higher customer spending. Like other countries, Kenya's tourism, education and other major sectors have been hit by the coronavirus crisis. Its economy shrank 1.1% year-on-year in the third quarter of 2020, compared with growth of 5.8% in the same period in 2019, as the pandemic hurt the hospitality sector, although growth in agriculture and construction provided a cushion. And that's it on the program. Thank you for watching. I'm Chimizi Obi Uwagu.